Hi, welcome to this video, which is all about how to make money in the Forex markets and make it quickly. Now, in terms of making money fast in Forex trading, what you want is really obviously good risk to reward trades, but you also want a result quickly. So your money is working hard. So you're either going to get a small loss or you're going to get your profit. You want your money working hard. This technique, when you do it on trade setups, you normally get a quick result. Now, the technique itself comes from legendary trader George Soros. It's the theory of investor anticipation. Now, in terms of what is it? Well, basically, when you're looking at Forex pairs and sentiment, you're normally looking to see how far the news is discounted in the price. Trader anticipation, you're looking to see what traders' expectations are, and are their expectations of what's going to happen got any substantiation in fact? You very often get traders that anticipate something is going to happen. It's just an opinion. There's no factual backup for the anticipation that they've got. And as George Soros says, when you see traders anticipating something, it's unlikely most of the time to happen, and you'll get a recoil back against the majority. Now, in terms of demonstrating the setup, it can come up at any time in any Forex pair. I'm just going to give three illustrations today, two currency pairs and a commodity, and we've covered these trade setups in videos on YouTube. Now they're going to be GBP, USD, CAD, JPY, and the commodity we're going to look at is crude oil. Now, in terms of two of the trade setups, great profits from them. The other one, we haven't got anything out of it yet, but we think we will. So yeah, let's just go and look at the trade setups, and I'll go through the theory of anticipation in more detail. And anyone can learn to do this simple technique. Most retail traders won't or don't think about it, but it's very powerful and will get you great risk to reward trades. Right, let's go and take a look at the technique, and we are going to look in terms of trade setups. First, we will do GBP USD. Right, first trade setup, British pound against the USD. Now, in terms, before we look at the trade setup, just read this quote from George Soros, because there's a lot of wisdom in it. The markets are not always right. Markets are a good discounting mechanism most of the time, but not always. There are times when animal spirits run supreme and emotions overshadow reason. Markets constantly discount events that haven't happened yet. As a result, they will often discount events that will never happen. Perhaps in relation to that last sentence, best example is crude oil, which we'll look at the end of this video. But in terms of this one, they're anticipating, when we come into the 120 level, that there's going to be a no-deal Brexit. And the market, when we start to sell off, particularly here, there's a frenzy in the media about a hard Brexit or a no-deal Brexit almost guaranteed, okay? Saying at the time, no, just go and look at the bookies, your local betting shop. What odds are they going to give you on a no-deal Brexit at this time? They're going to give you less than 20% chance. I think the one I checked was 16. That's not very good odds, is it? And you look at the sensible commentators who know Brexit, and they're all saying, not really a high chance for no deal at all. But the market and the financial media just went into a frenzy about it. And time was saying just come off the 120 level. So come off here, really get stopped out, small profit. Then here, through the 120 level, big massive monthly support level up. So another opportunity to get long. And look where we are now, 800 pips higher. I'm going to step back from the media, okay, because the media does very much reflect the herd psychology. And we do hear people say markets are always right, the price is the price. Well, that's true, but it doesn't mean that you can't get a good trade going against traders who've let their animal spirits run supreme. And this trade, obviously, we've been very focused in on it for weeks. It's finally given us what we wanted. We're hoping for more. Obviously, we get stopped out. We still have a really great profit from our British pound trades. And anticipation of traders into that 120 just really got us so bullish of this pair. Right, next example is one, like I said, that we haven't really got anything out of yet, but I think we could in the coming weeks. It's CAD JPY, so let's shift over and take a look at it. Right, just on chart account JPY now. Just in terms of this trade setup, just want to make a general point about market anticipation in terms of the CAD generally, which applies in all pairs. Now, the market is anticipating Canada will hold interest rates and not cut them until mid-2020. That's 8 months away. Okay, market anticipating holding till mid-2020. If you look at the facts, it looks like a cut could come in the next couple of months. Bank of Canada already indicating concern about business spending. It's dropping. That's normally a warning that the economy could turn down. They're also concerned about consumer spending, lowest since the financial crisis in 2008. In their statements, they're saying they're very concerned about the global economic outlook, slow up in the global economy and global trade. Canada's very exposed. They don't look like going to hold till 2020. Now, in terms of this individual trade setup, obviously this comes into play, but also trade wars. Okay, Japanese yen #1 safe haven currency, and trade wars accelerating. It's massive red candle here, or big red candle, a massive volume. I meant to say, go down, and we chop around. There's some optimism about trade wars being solved. We come up, there's no solution. It's all just kind of media rumor. We'll go short. 81.80. We fall quite nicely down towards the 80 level. So we've got 180 pips, but we don't bank. We put our stop behind this 20-day moving average, and she punches up and takes us out. It's again to do with optimism about US-China trade talks and a deal being done. And if you looked at what happened, the market rallies in anticipation of progress towards a deal. All you'd got was, they're expecting a partial deal. You kind of got a truce. That's it. Two sides are a long way apart. Speculators have bought heavily. They anticipated a good result. You could say that, it wasn't a disastrous result, but it makes no difference in terms of the sides. It's still a long way apart. And, the truce doesn't make any difference to global trade. So speculators very long. We've got a red candle day, but we're well off the lows. This level here, massive level to take out, because this level here is, or candles where institutions sold heavily. They'll sell heavily again, in our view. So there's a chance to have another go at it. So there we go, trajectory. Support, 82. Sell back through 81.80. Market just too bullish about the Canadian dollar. And from our perspective, we didn't get anything really out of the last trade. This trade we hoped to should get down to 79. Traders' anticipation for the Canadian dollar just way too bullish. Right, let's go to our final trade setup, which is going to be, of course, crude oil. Right, chart of crude oil, and in terms of this example, it is a really good one of traders anticipating things that just aren't probably going to happen. And you see this big spike up here. It's about 14%, I think, isn't it? Biggest one-day price spike in crude oil ever. Why did it occur? Well, Saudi Arabia had 5% of its oil production taken offline because of the attack with drones on the oil installations. And traders immediately assuming there's going to be a shortage of crude oil supply. But you look at the facts, there's no shortage of crude oil supply. There's ample supply in the world. The world is awash with oil. That 5% really no big deal, okay? Market also then anticipates it's going to be months before Saudi Arabia is back to full production. I saw, sensible media outlets saying, probably 6, maybe even 9 months. We said at the time, probably be weeks. Why? Because if you look at history, when oil installations get attacked, let's say, for example, in a war, how quickly do they repair them? They repair them in weeks. They're not complicated. It's not difficult to repair an oil installation. And Saudi Arabia, back to full production within weeks. It wouldn't have mattered if they were offline for months because there's still ample supply in the world. Then the market anticipates a war. You saw all over the media that America would get involved and fight with Iran. America never indicated that, or Saudi Arabia might go to war with Iran. No, just anticipating something didn't come to fruition. You get a big psychological price spike to the upside, animal spirits running wild, as George Soros would say. And then you've got a selling opportunity on your hands because big price spike comes up. Next thing, you got this candle here. That tail tries to poke up. That tail can't. We're red. So you've got the tails that do that. Always like it when you get big spike and then another go to it and it fails. Come in short. And then what happens? We get back to more realistic prices way below the base of the candle. So, in percentage terms, it's a really great move. Back below the base of the candle now, which should hold. Just an aberration candle. And crude oil for us going way lower, probably down to about 30. So you can see, in terms of this example, if you were reading the news, after the strike, you'd think it was absolutely disastrous for the global economy. This 5% was knocked offline, but no real big deal. And the market's just anticipating things that didn't happen. I like, one of the things I really like about Forex trading is, looking at anticipation and what traders' expectations are. And George Soros is right. They anticipate things that a lot of times just not going to come to fruition. You can use that in your trading. That is a simple technique. But George Soros, major part of his strategy. And with George Soros, everyone thinks that he got a lot of trades right. He got vast majority of his trades wrong. A small percentage right, but he had really big winners. He was a real master at judging investor sentiment and anticipation. His theory of reflexivity, really a great theory, which he talks about anticipation. I strongly recommend any serious Forex trader go and read it. There's a little summary, a simple technique that beginners should learn. A little bit of practice, and you can really get your odds on. Sorry, you can get the odds on your side with it. Anyway, right, that is the video for today. Thank you very much for watching me as usual. Take care. Have a good day.